You believe your money in the bank is safe. You believe FDIC protects you. But there is a law passed in 2010 that allows banks to use your deposits to save themselves. And most Americans have no idea it exists. Here's the truth, and it's uncomfortable. The money in your bank account is not legally yours. The moment you deposit money into a bank, it becomes the bank's property. You are no longer the owner. You become an unsecured creditor. That means you are lending money to the bank, and the bank promises to pay you back. Most people think a checking account works like a storage box. Money goes in. Money sits there. You take it out anytime. That is not how banking works. Your deposit is a loan to the bank, and every loan carries risk. This is why, when a bank fails, depositors are not protected the way they think they are. Now let me show you something important. This is not theory. This already happened in a modern, developed country, and it was completely legal. In 2013, Cyprus, a member of the European Union, faced a banking crisis. Banks made bad investments. Debt piled up. Collapse was imminent. Instead of using taxpayer money to save the banks, the government used depositors' money. Over one weekend, a new law was passed. When banks reopened, anyone with more than 100,000 euros in their account lost nearly half of everything above that limit. Money was simply taken. No warning. No vote. No choice. This is called a bail-in. And here's the part most Americans don't realize. The legal framework for bail-ins already exists in the United States. If you think this could never happen here, that's exactly what people in Cyprus believed right before it did. So ask yourself this. If your bank failed tomorrow, do you know exactly what legal rights you actually have to your own money? If this opened your eyes even a little, like the video and subscribe. Because what you don't know about the financial system can cost you everything. Most people relax when they hear one sentence. My money is FDIC insured. It sounds final. It sounds safe. But it is not a guarantee in the way people believe. Let's clear this up. FDIC insurance does not mean the government has a vault full of cash waiting for every crisis. FDIC is a fund, and that fund is limited. As of recent data, total bank deposits in the US are in the tens of trillions of dollars. FDIC's reserve fund covers only a small fraction of that. This system works only if a few banks fail at a time. It does not work if many banks fail together. And history shows that banking crises never happen one bank at a time. They happen in waves. When stress spreads, FDIC does not instantly send you cash. First, banks are merged. Accounts are frozen. Withdrawals are limited. Access is delayed. Even when payouts happen, they are not immediate. And here is the detail almost no one reads. FDIC insurance protects you up to a limit per depositor, per bank, per account type. Anything above that limit is not protected. Now here's the uncomfortable part. If the system itself is under pressure, governments don't like bailouts anymore. They create inflation. They cause public anger. So modern policy prefers bail-ins using private money first. This is not conspiracy. This is written into post-2008 financial regulations. The goal is simple: save the system before saving the depositor. That means protection exists, but only inside a narrow box. Most people don't know where that box starts and where it ends. So let me ask you this. If the system faced a serious crisis, do you really believe every depositor would get full access to their money immediately? Every major financial collapse has one thing in common: too much debt. Debt is not dangerous when growth is strong. It becomes lethal when growth slows. Right now, the United States is carrying historic levels of debt. Government debt, corporate debt, household debt. When debt grows faster than income, the system loses flexibility. Here, why that matters to you. Debt must be serviced. Interest must be paid. As interest rates rise, the cost of debt explodes. What was manageable becomes suffocating. This is where governments face hard choices. They can raise taxes, cut spending, inflate the currency. Raising taxes slows the economy. Cutting spending creates unrest. So the most politically convenient option is inflation. Inflation is a silent tax. It reduces the real value of money without asking permission. Savings lose purchasing power. Wages fall behind. Debt becomes easier to repay in weaker dollars. This is not accidental. It is a pressure release valve. Now connect this to the banking system. Banks hold government bonds. When rates rise, bond values fall. Balance sheets weaken. This is exactly what triggered recent bank failures. When confidence drops, people rush to withdraw cash. Banks cannot handle everyone leaving at once. This is why access limits appear. This is why temporary measures become permanent. The system doesn't break suddenly. It tightens slowly, and most people don't notice until movement becomes restricted. So here's the real question. If inflation quietly reduces the value of your money, is that safer than an open crisis, or is it just a slower loss? Financial systems don't collapse the way movies show. There is no single moment, no announcement, no warning siren. What collapses first is trust. When trust weakens, governments act fast, but quietly. The first move is always the same: control the flow of money. This does not mean confiscation. It starts with friction, withdrawal limits, transfer delays, technical issues, new compliance rules. Each step is small. Each step is explained as temporary. But temporary measures have a habit of staying. At the same time, digital systems expand. Cash becomes inconvenient, then discouraged, then restricted. Not because cash is dangerous, but because digital money is easier to control. Control is not about punishment. It's about stability. When money moves freely, panic spreads faster. When money slows down, panic stays contained. Now add one more layer. Governments begin to redefine what safe means. They promote government bonds, regulated institutions, approved assets. Anything outside that structure becomes risky by definition. This doesn't feel like force. It feels like guidance, and most people follow it because uncertainty is uncomfortable. The result is not collapse. The result is managed limitation. Life continues. Systems operate, but flexibility shrinks. And once flexibility is gone, getting it back is difficult. So think carefully about this. If restrictions are introduced slowly and explained as protection, would most people even notice when real freedom is already gone? By now, you understand the risks. Your deposits are technically the bank's property. FDIC insurance is limited and may not cover systemic failures. Debt, inflation, and financial stress can trigger bail-ins. Governments can restrict access quietly, step by step. Now the question is, what can you do? 1. Know your exposure. Check your balances. Know which accounts exceed the FDIC limit, $250,000 per depositor, per bank, per account type. Excess funds are at risk in a bail-in scenario. 2. Spread your deposits. Don't keep all your money in one bank. Split funds across multiple institutions to remain under insurance limits. Different branches of the same bank don't count, it's per legal entity. 3. Diversify outside banks. Consider assets outside the banking system. Treasury bills backed by U.S. government. Money market funds. Precious metals like gold or silver. Real estate. These hold intrinsic value and cannot be seized in a bail-in. 4. Limit cash exposure. Keep only what you need for daily spending and emergencies in a bank. Excess cash is vulnerable to bail-ins and inflation. 5. Businesses are highly exposed. If your business holds more than $250,000 in operating accounts, split it. Move excess to treasury bills, money market funds, or other safe assets. Avoid keeping all operational funds in a single bank. 6. Monitor warning signs. Bank stock crashes. Rising credit default swaps. News of loan defaults or stress in commercial real estate. When signs appear, act quickly. History shows delay is dangerous. 7. Educate your family and partners. Everyone who has significant bank deposits must understand the risk. Spread awareness before a crisis strikes. The law exists, the system is prepared, the tools for bail-ins are ready. The next financial crisis could trigger bail-ins over a weekend. Millions could see money disappear legally with no recourse. But the good news, you can prepare now. Understand the rules, protect your money, move funds strategically. Because once a crisis hits, it may be too late. Ask yourself one question before you leave. If my bank fails tomorrow, do I know exactly what happens to every dollar I've worked for? If this matters to you, like the video and subscribe. Staying informed could save your money.